Hello, everybody. Welcome to Speed Trader webinar number 10, titled How to Master the 3-Minute Chart for Maximum Profits with Jerremy Newsom from Real Life Trading. I wanted to thank all of you for joining us tonight. I know it's 8:30, and I know that all of you have a lot of charts to look at for tomorrow morning's activity, so I'll try and be brief, all right? I tell you, I came home from work today. I was so excited about this webinar tonight that I was thinking about it. I said, something. I need a little something to take my mind off this. So one of the things that I love, those of you that don't know me know, or those of you that do know me know, I should say, I live out here in Connecticut. And the one thing that I love about living in Connecticut is that I can drive down to the shore, wait for the boats to come in, and buy lobsters direct from the fishermen. There's a gentleman who takes his boat out, every once in a while, and he comes back with lobsters. I love it because when everybody else pays $6.99 a pound, I picked up 3 today for $6 right off his boat. I mean, right out of the water. Now, I've known him for about 6 or 7 years now, and there's a mutual respect between us both. I tell him, I go, Chucky, listen, I'll give you more. I feel bad calling you at the dock for $6. But he's like, hey, Don, it's my pleasure. It's good to see you. And it's just a really, really, really great thing. I suppose that is one little way all of us love to cut out the middleman. I also suppose if I ever owned a fish restaurant, I would have a solid business contact and vendor. With direct market access, you can achieve your very own middleman cut. Now, one of the things that I tell people do, I say, listen, try not to think of what is tangible on your statement when you see the trade plus ETN. Think about what's intangible, and that is the opportunity for a better fill. Okay, so let's do some quick math. All right, let's say you're with a competitor, and at $6.95 a trade, you buy 5,000 shares at $5. All right, so the price of the stock is $5 times 5,000 shares plus $6.95. Your cost basis is $25,006.95. Now, with direct market access, let's say you get a fill, same trade at $4.99 instead of $5. Okay, we give you a rebate of 20 mils a share, and the commission is $4.49. So that total is $24,944.49. That's $62.46 in savings on one trade. Okay, so if any of you have any questions about direct market access, please contact me directly. dhensley@stockusa.com. That's DHEN as in Nancy, S as in Sam, LEY @stockusa.com. Now, as I said, I'm really, really excited to get Jerremy on the horn today. I mean, he's got some excellent things that he's going to share with you all today. Jerremy, listen, before we get started, man, I got a couple of quick questions.
Yep.
One of the things that I noticed with a lot of the guys that trade in New York, some of them are successful, some of them are extremely successful, but very few of them are going to tell you what it is that they do to turn profit. I mean, what got you into trader education? What was it about, just giving back to folks that, how do you stay motivated with it? I mean, I'd assume that if there's a lot of work that goes into it.
Tons of work, a lot of hours. Yes, so many emails, a lot of text messages. One of the things that motivated me when I was young or younger, so I'm 30 now, but when I went to college, I went for a finance degree, and I was going to the University of Florida at the Warrington College of Business. And I thought that if going into college, you would get, they would teach you what the stock market is, how investing works, how stocks work. They would give you all that information. And as you know, it's kind of unfortunate that they never actually did that. They never do that. They never give you what it is that you're actually looking for. They never tell you about it. And as going through all of this in college, going through all these textbooks, learning about coupon yield rates and mortgage amortizations, I knew I wanted to trade. I knew the technology and the markets and the internet were going to only get faster. And man, it was just so expensive to learn how to trade the markets. Like becoming a doctor, but no loans. You couldn't go to med school. You had to spend $40,000. I went through so many seminars, And I just simply thought that there had to be a better way to present information. And dude, honestly, I wanted to be a history teacher for the longest time. I love teaching. I truly do. I like being in schools. I like teaching kids. Every single March, I have what's called Kids Month at my company, where I go and teach kids, kindergarten, second grade, fifth grade, all the way up to high school and colleges about the stock market. And I do that because I love teaching. I just realized that history teachers don't make any money, unfortunately. It's really a travesty how much teachers get paid in the States. But anyway, that's one of the reasons why I did it, man. I'm passionate about being able to help people understand something, because I always was told that I was having a learning disability, but most people have a teaching disability, and it's not. The teacher's challenge is to be able to find out how to explain that one concept for everyone to learn. That's just what fires me up, man. But the market in general is one of the greatest money-making opportunities in the world, so I want more people to learn about it.
Oh, that's fantastic. Well, I'll tell you what, I'm really excited about the content that you're going to provide for all the traders out there today. So yes. I'm just going to drop off and, let you do your thing. We'll do a Q&A afterward. How's that sound?
I'm down for that. Yeah, man. Thank you so much.
You got it. Go ahead.
All right, beautiful. So everyone, just make sure that you all can hear me well. And again, I apologize about that 2-minute radio silence. I actually had a background in radio, so the radio silence is like my nemesis. Type in a 1 into the chat pane if you can hear me. Just want to make sure I got everything pulled up and you can see my screen and everything looks legit and good to go. Perfect. All right. Got that sharing. That looks good. We're going to be drawing on the screens. We're going to be doing all kinds of things. This is going to be so amazing. I'm going to type in, let me see if I can access that. Lovely. All right, cool. So what we're going to do now is hop in and really discuss the 3-minute charts. We're also going to be discussing a lot more in depth about day trading specifically. As Don was talking about at the very beginning, one of the most important access to the markets is that speed and that accuracy, because in day trading, timing is everything. And we're going to be discussing tonight in this exact webinar where to get in, why to get in, what to look for, and how to properly and safely set up your trades. So in this particular situation, what we're going to be looking at is something referred to as gaps. And I think most people know what gaps are, but just in case, I will kind of discuss that. Gaps is when a price of a stock is different than the price of the previous day's close. That's really that simple. Meaning if a particular stock, whatever the stock is, right now I have VMware on my screen. If you have VMware closing at a certain price, closing at 143 on Tuesday, and it opens at 145 on Wednesday, that would be a gap, right? That'd be a $2 gap in price. And what's really exciting about this is if you can figure out and determine what a gap is going to do, number one, before it happens, and number two, once you get an idea of what the gap will do, you have the ability to interpret emotion. And interpreting emotion is what causes traders to do something very specific. Emotion causes motion. So if you just remove the E, emotion causes motion, and you want motion in a stock. You want motion in a day trade. You want that in and out ability to make money that day. Personally, I believe day trading is actually one of the safest things you can do in trading. I know that sounds wild, and most people won't make that accusation because they don't properly teach you how to mitigate risk, which I will be doing in this webinar. But most importantly, you are protected from overnight moves because, as you all know, especially with any current president, it doesn't matter who it is, you're going to get tweets and you're going to get messages and emails and notifications, and you're going to get just bombarded with news that's going to cause things to happen overnight. So what I want to do is I want to discuss a gap strategy that all of you are going to be very familiar with, and you're going to have tons of access to understanding how people are feeling. And this is actually a gap that is happening post-market right now on VMware. This is a live example, something that you all could be able to access the information tomorrow morning. So for those who are watching right now live, it is, it's pretty important to take kind of notes of what's going on and just kind of get an idea of what to look for. Gaps create emotion, and emotion creates motion. So let's go back to the daily chart, and we're going to talk about this for just a moment. There are a few stock market certainties, and I only have time to talk about a few of those tonight. But one of those stock market certainties is this. If you see a buying candle, and on a day chart, so this is a daily chart right now that we're looking at on VMware. If you see that, someone in the world was buying. And again, that's an absolute stock market certainty. We know that for sure. So we're looking at this, and we can look at it and verify and figure out where people are buying, what their emotion is. When I look at this on VMware, these 2-day candles, I'm seeing 2 bullish candles yesterday, actually technically today. Today was actually a little bit more of a high wave indecisive candle on VMW. But what we know for sure is that there is a buying candle on a daily chart. Someone in the world is buying somewhere. Since we know that for a fact, how do you think that person's going to feel? How do you think those people are going to react if the stock opens at this pink line tomorrow? What do you guys think? Go ahead and throw it in the chat pane, throw it in the question box. Let me know how you think those people are going to feel, because what emotion are they going to be feeling tomorrow for whoever bought VMware today and or yesterday, or maybe both? That's right. They're going to be a giant sad panda. They're going to be sad because the stock market is gapping down, and what I refer to as, and many other traders refer to it as, this is not like proprietary, but this is just a term that is used, very common in the industry, trapping. This is going to be trapping buyers. Buyers will be trapped. Buyers will be losing money. They will be sad, and they will be forced, or they will likely sell. So if you can see that these traders are trapped and they're losing money, right? We can tell this happening now because, again, VMware is gapping down post-market. Again, if I zoom into the 5-minute chart, pre-market, it's at 149 even, 149. So tomorrow morning, what I'm expecting, depending on how it opens, because right now we're watching this as 8:46 p.m. Eastern Standard Time. Depending on how it opens, let's say tomorrow we open and it kind of trades sideways a little bit and then breaks down. We're going to be looking to get in short because you have so many people who are going to be selling out of fear, out of panic. Maybe their stops are getting hit. They might not even be in front of the computer, but their stops are going to get hit and they're going to cause that selling. And that is what we want to take part of. Am I right? We want to take part of that selling. We want to be selling with them. So if you can be able to see and spot a gap before it happens, which again, one of the reasons I wanted to bring you to this webinar is I wanted to give you a tool that I use that is entirely free. And this particular tool is so useful for day traders. It begins working at 9 a.m. Eastern Standard. So 9 a.m. New York time. I'll post this link in the chat pane for everybody if you would like it. This is a gap up, gap down list. So 30 minutes before the market opens, I'm going to repeat that. 30 minutes before the market opens, you're able to see for free, right? No cost, no subscription, nothing. You're able to see what stocks are gapping. And then once you can see that, you are able to find out and determine what it is that you want to trade and why. Right? What it is that you want to trade and why. So I'm going to post that to the organizers. I'll see if Don wants to throw that in the chat pane to everybody if he's able to. But if just in case there's a technical glitch, it's barchart.com/stocks/performance. You have a gap up, and obviously you can see that link right there. There's a gap up and a gap down list, right? So you have gap ups and gap downs. Let's go look at the gap down list today because I love shorting gap downs. It's one of my favorite things to do. And I'm going to be looking for, so these are the gaps that occurred today. And you're going to get a nice, healthy list of these gaps before the market opens. And I'm going to tell you in just a few moments, 2 minutes in fact, what it is that you're going to be looking for specifically. So if you have a pen and paper, go ahead and get a notepad. We are recording this webinar, so you'll be able to watch it later. But you're going to want to take note of what are the few things that I'm looking for on a particular gap so that you will have the ability to trade it more effectively. So this is the gap down list. You'll be able to see LB, Hormel Foods, ESTs. I mean, here's all the list of stocks that are gapping down. A nice, healthy list. So you're not going to run out of opportunities, right? There's no opportunities out there that that you're going to run into. That's, you know, you're going to have all that you can handle. So I'm going to show you LB, L Brands. This was a phenomenal gap. We're going to be talking about right now the steps that you're going to want to use to qualify your gaps. So here we go. I mentioned 2 minutes ago that we're going to go to this list in 2 minutes, and now we're here. All right, so how do you qualify your gaps? How do you qualify your gaps? Actually, pretty easy. You want a gap down or a gap up. So you want a gap up or down of 3 to 12%. 3 to 12%. You want it to have 500,000 shares or average, or more on average. So you can look down here at L Brands, and you know this is a obviously very popular company. Tons of volume on this one. 5.9 million shares on average. You can see that kind of down there. So we have that on L Brands. That's number one. Number two. Number three, you want the gap to be clearing a recent support, aka ask yourself, where would people be placing stops for a bearish trade or bullish trade? So clearing a recent support or resistance. Now, some of you are going to ask, how recent, right? How recent would that be when you say clearing a recent support or resistance? 2 to 3 days or 2 to 3 months is fine. 2 to 3 days or 2 to 3 months is fine. And what that means is if you can look at the chart and you can, I mean, we're looking at L Brands right here. And again, this gap was on that list 30 minutes before the market opened. I mean, everyone and their mom can come here and draw support right there. So there was the support on L Brands, right? This is what I call perfect. If you want the perfect gap, you have it on your screen right in front of you. Just print this one out. Take a screenshot, print it out, and say, Jeremy Alexander Newsom said this gap is perfect. It is, because it has all the qualifications. I mean, it's right in that 3 to 12% marker. I mean, that's just a phenomenal gap size. Really, really good. It has more than 500,000 shares. It's clearing a recent support from the last 2 to 3 months, right? Just barely gapping down. Just barely gapping down. Right below that support. That's what you want. Because in this qualification, right, this list is pretty much done, by the way. You want the gap to be clearing support. Ask yourself, where would people be placing stops for a bullish or bearish trade? So if a stock is gapping down, you're looking for people to be trapped, right? You're looking for people to lose money. So where would they place their stops? And if you said, well, they're probably placing their stops below this pink line, you would be 100% accurate. That's exactly what's happening. They're placing that stop below that pink line, and this is what's happening today is they're getting stopped out. All right, wonderful. This is going good. I love it. You're keeping your attention. Thank you for being here, by the way, everyone. I truly appreciate it. It means a lot to me. And if you're watching this in a recorded version, thanks for being here as well. Thanks for watching. So what's next? Because the first step, we have to find the gap. All right, so we find gaps. Second step, we qualify the gaps. Now this takes practice. Practice makes permanent. There's no such thing as practice makes perfect because no one can be perfect. So practice makes permanent. Bruce Lee said, I'm not afraid of the guy who knows 1,000 kicks. I'm afraid of the guy who has practiced one kick 1,000 times. And if your brain was looking back at this gap right here on L brands, you would be correct. That was also a really good gap. Quite fantastic on July the 12th. That was another really fantastic one. So this is going to take practice, but once you find the gap that you like through a free scanner, they're all over the place, then you go and qualify that gap, and you want it to be doing one of all of these three things: a gap up or down 3 to 12, 500,000, clearing support or resistance where it's trapping people. Then what do you do then? All right, you then zoom in to the 3-minute chart. That's the name of the webinar. How to use the 3-minute chart for more effective and to maximize your profits. So when you're zooming into this 3-minute candle, here is what you are looking for. All right, so we're going to zoom in, and it is going to be this simple. You guys are ready for this? I'm telling you, this is phenomenal. Phenomenal. Wait until a bullish high wave candle shows up. Then set your entry below it. This is for a bearish gap, and I'll practice a bullish gap in just a second. Bearish gap. Wait for a bullish high wave candle, then set your entry below it and your stop above it. Mitigate your risk appropriately. Appropriately, I can't spell well. 1 R of risk, 2 R of target. And that's it. That's simple. Boom, you're done. We're going to talk about the risk. We're going to talk about the risk formula. I know we only have a limited amount of time together, but again, for those who are watching this recording, you can watch as many times. And for those who are here live, you're welcome to email me anytime you want. Be happy to help answer any questions. But this is what you're doing. So on a bearish gap, you are waiting until a bullish high wave candle shows up. Then you are setting your entry below it and your stop above it. So let's talk about what is a bullish high wave candle. What is that? A bullish high wave candle is this right here. The very first candle on LB, right? On a 3-minute chart, the very first candle is a bullish high wave candle. That's what it is. A high wave candle is a candle that has a massive upper and lower shadow relative to the body. Small body, specifically a white bodied candle. And when you're looking at a white bodied candle, that is where that's where your buyers are showing up. So I'm looking at this candle and I'm seeing a bunch of buyers. Now, here's what's really cool. If you want to qualify this a little bit better, check out this volume bar right here. Give me 3 seconds. So I'm going to point to this volume bar. Look at this volume bar, a giant bullish volume bar. That's giving you another indication that there's tons of buyers here, right? Because I already gave you a stock market fact number 1. I said if you see a bullish candle, that means that there are buyers, right? A bullish candle, there are buyers. So those buyers are going to be trapped. They're going to lose money if it breaks the low. So your entry is going to be below the low of that high wave candle, and your stop is going to be above the high of the high wave candle. Now there's 2 examples on this particular chart. Right, there's 2 examples here, and I'll see if anyone in the who's here live can spot the second one. But what I want to do is I want to realistically show all of you how I mitigate my risk in every trade. One of the things that frustrates me the most is when I go to a, in air quotes, professional trader, and they're talking about how they trade. They never discuss how they mitigate risk, because everyone at Speed Trader will attest that risk is their #1 most important aspect. It's all about risk. because all you need is one good trade to make money, and all you need is one bad trade to lose it all. So avoid the bad trade. Here's how I calculate risk. Ready? My risk is very simple. I do what's called a risk amount divided by my stop value equals amount of shares. That's it. Risk amount. Now, what is the risk amount? That is a great question. A risk amount is something that should be kept exactly the same. Most people will go 1 to 2% of their account size. 1 to 2%. So if you have a $30,000 account, you should be trading a $300 or less risk value, risk amount, whatever you want to call it. $300 or less. That's 1% of your account. So let's pretend that you're doing a $300 risk on this trade, right? That's your risk amount. Remember, each and every one of you gets to determine your risk amount. You get to pick it. That gives you a lot of freedom. You get to decide. So if you have a $1 million account, which some of you very well might, 1% of $1 million account is $10,000. Maybe you don't want to risk $10,000. Maybe you only do less than that. That's totally fine. Now remember, this is very valuable information that I'm sharing with you right now. There's no sales pitch coming up after this, because this is a great time for a sales pitch right now. No sales pitch. I want to give you the actual formula. So this stop value is really easy. This is your entry and your stop, the difference between those two numbers. That is first grade math. So the difference between $30.33 and where your entry is $29.42. That's 91 cents of risk. You take $300 divided by 91 cents, and that gives you the amount of shares to short in this example. And with Speed Trader, you're not going to have an issue shorting those shares, right, Don? It's easy.
No, you absolutely will not. As a matter of fact, we've got 3 fantastic ways for you to short, 2 on the same platform, and I will answer any questions that anybody has about that offline. But you're right about that.
Beautiful. And guys, that's a huge thing as a day trader, man. If I can't find shares to short, I wig out. True story. I forget the stock off the top of my head. Don, you probably already know what I'm talking about, Don. Don called me on my phone about a month and a half ago. There was this one random stock that ran up like 300%, whatever it was, in 2 days. And he said, "Hey man, do you need some shares to borrow for this?" Because we all knew it was going to short the next day. I mean, it was just bound to happen. You need to be able to find shares to short, because as a day trader, you care about speed and liquidity. If you are able to short something quickly, you're going to be able to make money with it. And as a day trader, that's your goal. So this formula right here is a very, very valuable formula. Again, write it down, jot it down. It's right here. Risk amount that you get to determine divided by your stop value, which is just the difference between your entry and stop. How do you know what your entry and stop is? Dude, it's right here. 3-minute chart. Right? 3-minute chart, wait for a bullish high wave candle if you are going bearish. Now, for those who are here live, type a 3 into that beautiful chat pane if you can see where the next high wave candle forms. And what I will do is when all the 3s, there they go, 3 is starting to come in, I'll show you what you're going to end up doing. But what you need to remember on this one is this is what I refer to as 1 R of risk. So 91 cents is your risk, right? That's 1 risk unit. You have a target of 2 times your risk. So 2 times your risk, pretty easy, right? 91 cents is your R. That's your risk times 2. This is second grade math. All right, 91 cents times $2 is $1.82. That is your target where you buy to cover. Now, obviously, if you're short, you're subtracting. This is still first grade math. Subtracting $1.82 from $29.42. And you're going to come up with your target of $27.60. And this is where you're going to have your limit order to buy to cover. So buy to cover. This is where you're buying to cover your position. This is where you're going to get out for your profit. So your risk was 1R, whatever that is. It doesn't matter. It could be $50, $300, $300,000, $17, $43. It's irrelevant. The math is the same. I will talk about why it's important to keep it consistent in just a moment. But what you'll see is L brands obviously never quite made it to 2760 because this is the end of the day. But you can see you would have been very profitable. Obviously, you could have just taken that stop and lowered it down a little bit to actually end up getting, you would have gotten trailed out or stopped out at some point, but you would have made a profit. That's what's key. Now, for those of you who are typing in the 3 into the chat pane, for those of you here live, I'll show you where that second high wave bullish candle showed up. Because again, that's all you have to do when you're shorting is wait for that candle. Keep in mind, this strategy works just like every strategy some of the time. That's one of my sayings in the market, ladies and gentlemen, is everything works, just not all the time. That's why in this very first webinar that we've ever had together, me, you, and everyone else, I got to teach risk mitigation because that's all I care about. Money, I love money. It's phenomenal. It's an incredible tool. Dave Ramsey said it can be a brick to build a house or a brick to throw through a window and rob somebody. Money is a tool. You got to protect it, keep it around. If you want more of it, you got to protect it, ladies and gentlemen. So it's all about risk. Let's now do the different formula because this was your other bullish high wave candle on a 3-minute chart right there. And your entry would have been below the low and your stop would have been above the high. Boom, bing, bong, it's it. Your stop 29.12, your entry 28.84. You're going to go back to first grade to do the math. You're subtracting the two numbers. Now remember, if you're like, where'd I get 28.84 from? It's below the low of this high wave candle because that was 28.85, and my stop's above the high of that candle. So you would have taken, in this instance, $300, and you would divide it by 28 cents, and that will come up with the amount of shares to short. And that will be a little bit more shares this time, right? So again, Speed Trader is going to, I mean, it's literally in the name, Speed Trader. You're going to be able to short 1,071 shares. Boom, same exact risk, but you have now increased your share size. A lot of traders do this wrong. They trade the same share size all the time. They trade in even lots, as it's called in the trading world, and people laugh at them because if you trade in even lots and you're always trading 1,000 shares on everything, there is a use for that, but there can also be a detriment for that if you don't know the math, and the math all comes down to risk, right? If you always do 1,000 shares, but you risk 20 cents every single time, perfect. That's fantastic. If you buy 1,000 shares and sometimes you risk $1, sometimes you risk $2, sometimes you risk 20 cents, that's dumb because that's a whole different risk profile. Your risk varies. Let me show you why risk is truly important. I'm going to pick two people who were here kind of at random, Bob and Sherry. So I'm not picking on you guys. This is just, you're just going to be purely an example, if that's okay. So Bob, let's say you take 4 trades and you do a trade that's worth 300 and you win on that trade. You win on the trade, that was your risk, right? Your risk was 300, you won on the trade and you got $300 and you're feeling all good. Next trade, you do the exact same thing because you're a smart guy. You take $300, you win on that trade, you make, I don't know, $350, a little bit more than your risk. Good job. You take another trade and dude, you just crush it. 2 times your risk. Look at that, man. Back to back to back winners. What are you, Golden State? 3 winning trades in a row. And what does Bob do, ladies and gentlemen? Oh man, he gets pumped up. So now he risks 1,000. And we all know what happens now. When you risk 1,000, he gets a little uncomfortable. The trade starts going against him. He actually ends up losing $2,000 because he gets all scared and worried and sad. And Bob is now losing money, even though he's a 75% batting average. That's what we call it in the pros, by the way, batting average. You can call it win-loss ratio. That's fine. But a lot of people use the term batting average, even though it's trading. So win-loss ratio. Now, Sherry We're going to use Sherry as an example. So Sherry is a consummate pro. She's an epic real life trader. She is just a stud muffin. And what she does is she trades and keeps her risk the exact same. So she does 300. Now she doesn't take the trade as well as Bob on the second time. So she actually loses $300. So she loses one of her R's. Third trade, she does very similar to Bob. Bob and them, they take the exact same trade. Everything is good. Or maybe they were in a trading room or something. And then Sherry, on the fourth trade, she does one thing different. What does she do, ladies and gentlemen? Can you tell me? She does one thing different on this trade than Bob did. Exactly. She risks her $300. You know what? She loses on the trade. Her and Bob both lost, but here is the crazy thing about this. You ready for this? You probably didn't even realize this. Sherry is actually making money. She is net positive $300. Do the math. She is net positive $300 doing the exact same trades that Bob did and actually performing worse. She's a 50-50 trader. She gets 1 out of every 2. Yet she has a net positive result. How is that possible? That's because she stuck to a consistent risk. My friends, this is so important in trading. It's unbelievable how many people flip their risks every single trade all the time. Keep your risk the same. I don't know if any of you are scientists or engineers here. Type in a 7. Actually, type in a 7.314, almost double pi. If you're a scientist or engineer, or chemist or teacher, beautiful. And the reason I was asking is because you will know if you want to measure something or you want to do an experiment, you have to have a control. You have to have something that's not a variable. Otherwise, you won't know what's good and what's bad. You have to keep your risk the same in trading, because without that, you won't know if it's you or if the market is all rigged. I'll give you a hint. It's usually you. It's usually your fault. So now what I'm going to do is I'm going to hop over to a bullish example just to make sure we're all comfy with this particular concept. I'm going to come over here to a daily chart first, right? Because remember, that's how you're going to qualify the gaps. And what we're doing is we're looking at Honeywell International, ticker symbol HON. This was a gap that happened today. And it was a black candle gapping up. You'll notice it was a nice small gap. Okay, just kind of drawing this. So here's your small gap on Honeywell. It was a black candle yesterday gapping up, which is another stock market certainty. Here's stock market certainty number 2 for everybody. If you see a bearish candle, someone, somewhere in the world went bearish. Went bearish. That's a stock market fact. Now, as many of you may or may not know, if you go bearish on a position, the only way to exit is to buy to cover. That's it. It's the only way to exit. You have to buy to cover to some degree. At some point, some level, some juncture, to exit a bearish trade, you've got to buy to cover. So if that is the case, that means that there's going to be buying pressure that comes in. All right. So very similar to the bearish example, when you are going bullish, wait for a 3-minute high wave bearish candle, right? Short sellers, and enter above the high and place your stop below the low. Boom. We'll do another example, another bullish example in just a moment, and then pretty much our time will be up. So Honeywell, I'm gonna hop in here to the 3-minute chart, and the 3-minute chart, the very first candle that actually showed up was a high wave bearish candle, the very first one. Now, what's really cool about this is I'm actually going to show you a trade that may or may not have worked out that great. but you definitely didn't lose a lot of money. And that's kind of the benefit of this this program tonight. I want to teach you how to mitigate your risk. So your entry would have been above the high with the bullish stop limit order. 158.27. Your stop is at 156.96. Let's go with the $300 risk. $300 risk. Who can tell me how many shares you would have bought in this scenario with a $300 risk? And again, this time it's a little flipped, right? 158.27, that's our entry, minus 156.96, that's our stop. And you're going to come up with $1.31. And 300 divided by $1.31 equals 229 shares. So in so doing, right? So in so doing, you know how many shares to buy. Rather than just randomly buying 100, because if you bought 100, your risk is too low. If you bought 1,000, your risk would have been too high. And what you'll notice is this trade did not trigger for 3, 6, 9, 12, 15 minutes. 15 minutes into market open, this trade would have triggered, right? You had your beautiful S-curve pattern, right? And after approximately an hour of being into the market, the market's been open here about an hour, you're not up that much on this particular trade. It's kind of moving, it's kind of not. All of you know how to move stops to some degree. There is obviously some practice that can be had. There is tons of things that you can use to get better at moving your stops. But bottom line, you would have eventually moved your stop. And what I'm going to do is I'm going to draw where we moved our stop today in the trading room, and I'm going to show you a losing trade. All right. So here's obviously some type of pivot that was forming, right? You had a bullish candle here. It made a new high of the day. Right, we came back down to that support, we bounced, and we started rolling over. And what do we see? We started to see a lower high. That's obviously not what you want. So when it trades down to this, again, this market's been open an hour and a half at this point. Starts bouncing. At this level, you don't have a consummate winner on your hands. This is not a huge winner by any means. So you come down and you move your new stop right below the low of this candle right here. I'll hide my drawings for a second. Right below the low, I'll actually zoom in. This candle is a great candle to get stopped out on right there, because if it breaks the low of that candle and it takes out that little pivot that I drew, so now what I'll do is I'll put my lines back on. So there's the pivot, right? You can see that's forming. Again, this is a 3-minute chart. So it's faster than a 5, but slower than a 1. So you're going to have time to figure out what the candles are doing. So this right here is 12 whole minutes. Anyone here can do anything in 12 minutes, right? So Honeywell, I was thinking about making a joke, but I decided to take the clean path. Anyway, so you move up your stop. You have a new stop on this particular trade, right? You increase your exit. And you know what? You take the L on this trade. New stop. And these are 2 trades that we did trade in the real life trading day trading room today, Honeywell and LB. But what happens is you'll notice that if you lost on this trade, I'll actually show you a really cool tool that I really like using. On the other trade, you would have won about, so on LB, what I was talking about, if you took that first 3-minute candle, you would have won a little more than 1 risk unit. So here was the trade on this one. Here was the original trade, right? The original stop was all the way down here. So that's the original stop. And this is what you would have wanted it to do, right? Obviously, you would have wanted it to go and just go all the way to 2 times your risk. So that's 2 times your risk right here. You'll notice this little box that says risk reward ratio 2, right? Risk reward ratio 2. So that shows you that's 2 times your risk. So the box in red is what we were originally risking. The box in green is what we wanted it to do. And it just didn't happen. So what you would have done is over, an hour of being into the trade, you would have increased your stop. You would have got stopped out on the trade, and you would have lost incredibly small, right? You would have lost less than your one risk unit. In fact, you would have lost 0.35 R's, 0.35 risk. So here's the cool part. Let's say you made 1 R on LB today. That's one risk unit. You made one risk unit, so that's 300 bones, 300 denarii, 300 euro, whatever. And you lost 0.35 on Honeywell today. So 0.35, that's your full R is 300. That's like a full risk unit. So you would have lost 0.35 of that amount. Everyone follow me? So the cool part is, overall, we can do the math, right? 1 minus 0.35 equals you're up 0.65 R for the day. So that's a little around $180. $180 gain between two trades, and you have a 50-50 win-loss ratio. It's all about risk. It's all about calculations, and it does come down to your plan. Having to know when to move your stop, having to know exactly how long it should take you before you move your stop, being able to really be crystal clear and figure out what it is that you're looking at, why you should move your stop, when you should move your stop. But very oftentimes, the first 3-minute candle that you'll get will be that high wave indecision candle. And when you get one of those candles that is, again, if you're bullish and you get a bearish candle, or if you are going bearish and you get a bullish candle, those are some really good moves. Now imagine that you're a trader that you start doing this for a while. Now I did not do this trade, right? But imagine you start practicing this more and more and more. And remember, the original entry was right there and the original stop was right there. And I talked about earlier not getting triggered in for a while. What if once you saw this candle right here, which is a perfect doge, by the way, that's a perfect doji. That means the open and the close is numerically exactly the same, 157.99. I mean, to the penny, ladies and gentlemen, that's a perfect doji. That is the epitome as it's spelled, but epitome as it's pronounced. That is the epitome of indecision. When you get a perfectly just, who the heck knows what's going to happen? It opened and closed at the exact same price. So in that situation, could you have set up an entry right above that high, right? Lowered your risk tolerance a little bit. You could have kept your stop the exact same, but what if you actually lowered your entry a little bit? Or what if you also took your stop and moved your stop up a little bit, just collapsing in and making that risk smaller? You would have actually eventually won on that trade, because over time you most likely would have moved your stop right there below that hammer on that double top, and you would have gotten trailed out for a super small gain, 0.3 Rs, 0.4 Rs, something like that. But not a bad deal. Or even if you didn't get trailed out there, but you got trailed out around the same exact price that I was talking about earlier, your loss would have been even smaller, maybe like 0.2 rather than 0.35. So you'll get better at this. You'll have time to get better at this with practice and getting good screen sessions, getting a lot of trading time in. But I have certainly accumulated well over, I would argue, 15,000 hours in front of the charts, in front of candlesticks, in front of actual live markets while it's moving, helping people from all around the world of all ages learn this stuff. I go to schools, right? I'll teach third graders how to trade the 3-minute charts. It's not hard. It's all about risk, and it's all about being able to master one particular approach. I know traders who just only take bullish trades. I know traders who only take bearish trades. I know a guy named Seymour, one of my really good friends, good coaching buddy. We chat every single day. He trades only AMD. That is all he does when he day trades. Like 98% of the time, he's trading AMD, advanced micro devices. That's it. And look at this monster today. AMD 3-minute chart, ladies and gentlemen, is this a high wave candle or what on AMD? The answer is yes, that is indeed. Entry right there, 21.51. Stop right there at 21.40. That's 10 cents of risk. Seymour is out with his 2 R's right there, and boom, he kills it. This is like, that's all he does. He just trades AMD, looks for good trends. You know, again, early in the morning, looks for that high wave candle, and sometimes it works, sometimes it doesn't. But with proper risk mitigation, you can easily make money doing this because there is a math formula, and math is scientifically accurate. If you lose less money than you make, you will be profitable. My boy Seymour, with 4 kids and his wife, lives in North Carolina, quit his job at Best Buy like 5.5 weeks ago, and now trades full time and is happier than ever with a simple strategy, the strategy that I'm sharing with you tonight. So I'd love to know if you have any questions. Don might hop on the horn as well and help, kind of just facilitate any questions. If you have any questions, let me know. But Don and here, we're going to be here the rest of the night, just doing what we can to help answer your questions, make you guys feel comfy.
Yeah, no, definitely. We actually have a few questions that are out there right now. Looking for, one gentleman wants us to know, can you please repeat the link for the bar charts and performance for the gap up and gap downs that's prior to 9 a.m.?
Yep, absolutely. Fantastic question. So I'll show you actually a way that you can Google it. I mean, it's so wildly amazing. Pre-market gappers. Like, you can literally type this into Google. I know I know plenty of, like, quote unquote stock trading gurus who will sell you a stock market scanner for like hundreds or thousands of dollars. Dude, you can go to Google, just type in pre-market gappers, and you're gonna get like numerous ones. So this is the NASDAQ, that's a great one. Stock Market Watch, that's a great one. Pre-market scanner, Market Watch, that's really a good one. So you're going to get all of those, but if you type in pre-market gappers bar chart, pre-market gappers bar chart, you'll get the very first thing that comes up will be that bad boy right there. You click it and that is it. So just use Google. Google is your friend. Great question.
There you go. There you go. We got another question, and this may be a little technical, a little preference, but Andrew's wanting to know why the 3-minute candle versus the 2-minute or the 5-minute.
I love it, Andrew. Fantastic question. So 3, I love the 1, but I'll be honest with you, man, the 1 is extremely fast. It's going to give you a lot of noise. It's going to talk you into a lot of trades. It is one of the fastest chart settings that you can get in trading. Now, for most of you who are here, you might be getting into trading, right? Meaning you're taking your first steps, you're learning how it works, you're getting into the swing of things. The 1 and the 2 is usually a little too fast for most beginning traders because you will have to set up your trade, you have to calculate your risk, you have to understand what the candle's doing. 3 minutes, what I have found, is a really comfortable time. Even if I got a guy named Greg who's 68 years old. So if you're older than 68, hey man, phenomenal, right? Anyone can trade. It doesn't matter how old you are. But I'm saying Greg is a little bit slower technology. He's mentioned this to me numerous times. But 3 minutes is pretty comfortable for him. 5 minutes, I love the 5-minute chart, but it can also be a little on the slower side, right? Because here's a 5-minute chart, and you do this with AMD, all you see is white bars for the first few minutes, right? You never get a chance to see that indecision candle. It just kind of keeps running and running and running. So 3 minutes kind of helps consolidate it. It chunks it down a little bit more. It gives you a little bit more time. And I found to be a super useful time frame for day trading because the 1 and the 2, as much as I love them, I'm just realistic with most traders who learn how to trade. Being able to determine their entry, their stop, their target, setting it up in the broker, right? Whatever broker you use, hopefully it's SpeedTrader, but whatever you're using, it's just a little on the fast side for some of you while you're starting out. But once you get it, once you understand the sentiment, once you know what it's doing, you'll be able to see, right, on the 2-minute chart, here's AMD and here's that little black candle right there, but it's not quite as crisp, not quite as defined. So I get it, Andrew. Phenomenal question. I just like the 3 because it's like the Goldilocks of porridge. right? It's not too hot, it's not too cold, it's just right.
Excellent, excellent, very good. Well, listen, Jeremy, I tell you what, I think this is just fantastic, man. I gotta have you back for more of these.
Really?
Oh, absolutely,
Nice.
absolutely.
Okay. Heck
Yeah,
yeah.
definitely. Yeah, long story really, I'll keep this brief. Jeremy and I met over in Orlando. We were at the it was a trading summit down there,
Yep.
and man, I just got to talking to this dude, and he's just so proud of where he's from. He showed up there with a couple of his friends, and I made the mistake of saying that I had the best barbecue I ever had in my life in Texas. This guy's from Tennessee. I thought all of them were going to jump me out in the parking lot. I was like, whoa, this is getting crazy. But yeah, man, we're going to have you back.
Awesome.
If people are looking to sign up for your service, if people are looking to get in touch with you, if they have other questions, if they have things, how do they reach you? What's the best way for them to get in touch with you?
Thank you, man, for asking. Yes, ladies and gentlemen, just email me, Jeremy at reallifetrading.com. That's my personal email address. I do answer it all the time. I check it. If you don't hear back from me within 24 business hours, like 24 clock hours, just email me again, because it either went to my spam or my junk folder and it just didn't get there. And if you do want to learn how to really properly day trade, just hop over to reallifetrading.com. I have a copious amount of content designed for anyone. If you're insanely advanced, Andrew, and you want to do 1-minute charts, all the content is free. I don't charge for the content. I love providing education because I know that my mission is to enrich lives, and hooking up and partnering with people like Don and like Speed Trader and like you guys, like you all. I know that more people will learn how to trade, and the more people know how to trade will be able to impact the world financially. When more people have financial prowess and understanding, then we can change that entire perspective of the whole 1 to 2% people in the world being rich. Let's get it to 3, 4, 5% of the whole world having tons and tons of money. We can make that shift together. And so that's kind of why I did that. But yeah, reallifetrading.com, or just shoot me an email anytime you want.
Excellent. Excellent. Well, that concludes today's webinar. Again, everybody, thank you very much for showing up today. If you have any questions, please email me directly, dhensley@stockusa.com. Best of luck in the markets tomorrow morning.
Yep.
I hope everybody stays well. Thanks again.
Take care, guys.